Okay, this is your Ichimoku Cloud update for Monday, May the 24th. And here what we're looking at is the S&P 500 index. And this is a daily chart going all the way back to the beginning of August. And here we are, May the 24th. As you can see over here on the right hand side with the mouse, we've broken the cloud. So when the chart breaks the cloud on the daily chart, we never want to be in an overly bullish position. Maybe on very, very few small things we could find sort of an outlier that might be bullish. But overall, when something breaks the daily cloud, we're always going to have a bearish outlook. And that outlook's been working out very well for us in the SDS, S&P 500 Double Inverse ETF. This is the same chart here, and I have down below here a momentum indicator. And what you can do with the momentum indicator is you can actually chart the indicator itself just like you would chart a stock. So what I did here is I drew two trend lines. You can see the downward sloping red trend lines. Typically you only really need the upper line here, which is the downward sloping resistance line. And as the momentum is slowing, at the same time the market was going up. So it's something to look for. You're looking for a breakdown in the market ahead of time, waiting for all these indications to sort of come into play, because momentum is a leading indicator. And even though we are holding SDS, it's actually better to chart using just the normal index, because the SDS and all the other double inverse funds or just double ETFs that go with the market, they will change the percentage every day. So they close out the prices daily and then they will change again, so it will actually skew the chart over time. So it's always best to chart with the normal charts and then use the double inverse ETFs and double ETFs as we're trading. Gold. This is the daily chart on gold, and it's trading above the cloud, but it's a little bit weak lately. It's broken the Tenkan line, which is this red line here. It's broken the Kijun line, which is this green line here. So now isn't necessarily time to really be adding to the gold positions. If you're a long-term gold bug, it's fine to hold here as long as it stays above this daily cloud. But it's not necessarily something I'm going to be jumping in right now. The story still continues to be the US dollar. It's all about the US dollar. And where's the US dollar going to be in 6 months? I don't know, but we're traders, and to us it doesn't matter. I've been bullish the US dollar for over 2 months now. We already had the 42% gain on the US dollar index calls using ticker symbol UUP. And it's just the story. The euro is the opposite. Stay away from the euro. It's in the low 120s now, and there's no reason whatsoever the euro couldn't be at parity or even below the US dollar by the end of the year. I wanted to break down the gold chart just a little bit more. This is the 60-minute chart. As you can see back here at the late April, it really had a great run. Touched the cloud a few times, continued higher and higher, and now it's actually broken the cloud. It broke it on the 19th of May. So as a trader, if something breaks the 60-minute cloud like on gold, there's really no reason to be in gold whatsoever. It is one of the strongest relative strength plays, which means that the pullbacks will probably be relatively small. But for now, for new positions on gold, if you're thinking about it, I would wait until it breaks the 60-minute cloud to the upside. There's really no reason whatsoever to add to any new positions in gold now, even though the long-term fundamentals are there. The Fed is, all the currencies all over the world are printing money a lot faster than the gold mining companies are mining gold. And here we have the euro. What a disaster this chart is. Broke the daily cloud way back on the 14th of December, and from then on, if you were just a cloud trader, man, did you have an absolutely unbelievable run. 1.4559 all the way down to 1.2271 or so, still holding the short, approximately 2,000 pips just trading the cloud. And remember back here at about 1.365, a little bit before, that was when some of these talking heads on CNBC, like Mark Faber, he's a multimillionaire, but when you have millions of millions, you can afford to be incredibly early and even quite late and still make a lot of money. But for us as traders, we really have to be on the ball. And these guys like Faber, guys like Rogers worked at a hedge fund when he was in his late 20s and early 30s, and he made his millions and basically retired at 35. But he made those in speculative futures. Over and over again, he was consistently right, and now he's just turned into a multimillionaire long-term guy, and that's really not what it is for us. For us, we're trading, and I didn't want to get into the euro, and I said it could touch the cloud. It did, and it just plummeted over 1,000 pips from that cloud touch. In order to go bullish, on the euro, there's absolutely no reason. It's like catching a knife, catching a falling knife. The longer you wait, it doesn't matter how close to the bottom you catch a knife, you're still going to get cut. And so there's no reason at all to be long the euro. One of my favorite stocks to chart, and one that I chart daily, is Freeport-McMoRan. This is the old Phelps Dodge that got bought out, and it's one of the biggest copper companies in the world. And since copper is a major indicator of the global economy, because all copper prices are basically global in demand, it's really a good leading indicator of what's happening economically. If there's a lot of construction around the world, of course, copper is going to go up. If demand is falling, copper is going to go down. But what I've been saying for a long time in the newsletter is that the prices of copper, the prices of gold, the prices of everything are based on not only future expectations, but the future expectation of the growth rate. So even if there is more construction globally year after year after year, if the demand is not growing at the same rate that has been expected, then the copper prices will actually go down as the economy is picking up, because it's not picking up at the same rate that was expected. So here in Freeport-McMoRan, it broke the daily cloud back here on the 4th of May, and there was absolutely no reason to be long whatsoever. And we shorted this. We didn't short, we bought puts on FCX, and when it kind of rebounded here, I got out. But so many times you take the profits and things do continue to the higher side, but perhaps once every year or two, things will just dramatically collapse. But we were out. We took our profits, we got out, and we made money on other shorts like SDS and the short on YGE and the short on MAN. So here we are, FCX. It broke the previous bottom, and there's no end in sight, really, for FCX. And when you look at the copper stocks, you really get a good indication of what's happening in the overall global economy. Okay, we're back here to the S&P 500 again, and this is the last chart that I wanted to show you here. And this is the 240-minute chart, and it's one of my favorite time frames. It's a time frame that not a lot of people use, and it's only going to show you about 1 or 2 candles a day. And I wanted to go briefly here and take a look at this line here, where this happened when the bids fell out on several stocks on the Dow, and you might remember a few weeks ago when the Dow dropped 1,000 points. It probably should have only dropped about 500 points. And when we look over here and we see this big spike down to about 105 on the S&P 500, this actually should have never occurred. So when I look over here at the cloud, this is the first time I can ever remember something happened and it actually skewed this cloud. So this cloud should actually be back up here at about 117. And so when the S&P 500 trades below the 240-minute cloud, it can usually trend this for several months. So again, there's really no reason whatsoever to be bullish in the market. If stocks rally for a day or 2 or 3, it's only going to be rallies to new resistance. It would take an absolute tremendous amount of rallying for several weeks for stocks to become bullish again. So right now we're bearish in the pre-market. Stocks are down, so that's great for us because we have our SDS double inverse. And that's it for this week's update. Thank you.